Well, hello there. You found me in a reflective mood today. Not that there's any other kind at my age. You get to a point where looking forward and looking back, well, they start to feel like the same direction. You've asked about selling, about letting go. That's a question that seems to chase people, haunt them even. Should I sell now? What if it goes higher? What if it crashes? It's a peculiar kind of agony. And I've watched so many smart people tie themselves in knots over it. You see, we're surrounded by noise about buying. It's constant, a cacophony. But selling, that's the quiet, lonely decision, the one you make in here, not out there. No one's cheering you on for a sale well-timed. They only cheer for the buys. But selling might be the more important skill. Knowing when to hold on is wisdom. But knowing when to let go, that's a deeper wisdom. Still, my partner Charlie, he has a way of cutting to the heart of things. He once said, and I'm paraphrasing here, the first rule of compounding is to never ever interrupt it unnecessarily. I've turned that over in my mind for a long time. Never interrupt it, because most selling, it's just unnecessary interruption. It's you getting in your own way. It's letting a temporary feeling, a headline, a bit of envy dictate a permanent action with real consequences. There's a tax man, of course, who always gets his cut. But worse, there's a psychological tax. Every sale is a verdict on the business, yes, but also on your past self. The me of today judges that the me of yesterday was a fool. It's a messy business, but to say never sell, that's dogma. And dogma is just laziness dressed up as conviction. The world changes, you change, the math changes, also the rules change. And you ignore that at your own expense. The government only taxes you on gains when they're realized, meaning when you sell. And the same goes for losses. You usually only get to use them when you sell. That alone is a reason to treat the sell decision as a lever, not a reflex. The IRS lays out the basics pretty cleanly. Capital losses can offset capital gains, and if losses exceed gains, you can generally subtract up to $3,000 per year against ordinary income with the excess carried forward. Those are real dollars. That's real compounding you get to keep. But it only shows up if you're thoughtful, not twitchy. So over the many decades, I found there are really only three times when selling isn't just permissible. It's the rational, the responsible, the necessary course for a steward of capital. They have nothing to do with the daily drama of the ticker tape, nothing to do with fear or greed or the itch to do something. They are quiet reasons, business reasons, owners' reasons, and I suppose they are human reasons. The first reason, when you've made a mistake, the agriculture of error. The first is the most humbling. It's when you must look in the mirror over your morning oatmeal and say, I was wrong. Now, that seems straightforward, doesn't it? Obvious. If you make a mistake, correct it, but you'd be astonished, truly astonished, at the intellectual contortions an otherwise rational person will perform to avoid that simple admission. We are storytelling creatures. And when the facts contradict our story, we don't abandon the story. Oh no. We invent new chapters, we add convoluted plot twists, we blame the narrator, we anchor on the price we paid. I can't sell below $50. I'd be taking a loss. As if that $50 price tag chosen on some Tuesday months ago has any mystical bearing on the business's intrinsic value today. It's a sunk cost, a ghost, and yet we let ghosts make our decisions. We tell ourselves it's a long-term play to disguise a bad initial decision. It'll come back. That's the siren song of the value trap. A terrible business at a cheap price is still a terrible business. It's like buying a leaky boat because it's 70% off. you didn't get a bargain, you got a sinker. And no amount of hoping will patch the hole in the hull. I have plenty of personal experience here early on, especially. You don't get to be 90 without making every mistake in the book. Some, I'm afraid, I invented new chapters for. There was a retail business, I won't name it. No point in embarrassing anyone further back in the late 1960s, I believe. Seemed a decent enough outfit, friendly management, clean stores, the numbers. Well, the numbers told a story of steady but unspectacular returns. My mistake was in confusing a decent business with a great one, and worse, in assuming that decent could become great with just a little more time. The economics, the fundamental engine of the business were mediocre. Thin margins, no real pricing power, a moat that was at best a decorative garden pond. But I liked the story, I liked the people, so I held. And as the years ticked by, that mediocrity became entrenched. The world didn't end, the company didn't go bankrupt, it just puttered along. My capital was trapped in a puttering engine when outside there were Ferraris idling, waiting for fuel. The mistake wasn't in the last quarter sales figures. The mistake was made at the moment of purchase. I had misjudged the quality of the enterprise itself. I had bought an oak sapling while telling myself it was an apple tree. And that's the key realization. You must separate the decision to buy from the decision to hold. They are linked, but they are not the same. The buy decision is based on a hypothesis. This business at this price will compound my capital at a satisfactory rate over time. The hold decision is a continuous retest of that hypothesis. When the evidence overwhelmingly shows your hypothesis was flawed, not because of a temporary slump, but because you misjudged the core nature of the thing, you must act. You take the loss, you swallow your pride, it tastes terrible, like a bitter pill. But in the long arc of compounding, admitting a mistake quickly is a virtue that compounds just like money. That capital stuck in a mistake isn't just dormant, it's an active liability, it's opportunity cost. It is the wonderful business you cannot buy because your funds are held hostage by your own earlier error. Think of it as farming, which is a metaphor I rather love. You're the steward of a field, your capital. You must plant seeds, your investments that will grow into productive fruit-bearing trees. You study a seed catalog and you pick one labeled apple, golden, delicious, high yield. You plant it, you water it, you watch, but as it sprouts and grows, the leaves aren't right. They're serrated, not smooth. The bark is rough in the wrong way. By the second year, it's unmistakable. This isn't an apple tree. It's a sycamore. A fine tree for shade, perhaps, but it will never, ever produce a single apple. You are not in the shade business. You are in the apple business now. You have a choice. You can stand there year after year watering this sycamore, fertilizing it, telling yourself, well, it's a very nice tree, and look how tall it's getting. Surely it will produce apples eventually. Maybe it's a late bloomer. That is the path of pride, of stubbornness, and your field will forever be one tree short of its apple-producing potential. Or you can do the hard, humble work. You can take your spade, dig up the sycamore sapling. It's easier now than later, and replace it with a genuine apple seed. You accept the season of lost growth. You accept the empty patch of dirt for a time, but you have realigned your field with your purpose. Selling a mistake is digging up the sycamore. It's not a failure of farming. The failure was in misreading the seed packet. The successful act is the correction. This first reason requires a brutal, unsentimental honesty, mostly with yourself. You have to quiet the voice that says, if I just wait, it'll prove me right. Sometimes the only thing waiting proves is that you're a more patient fool. So you sell, you liberate your capital, you set it free to find a proper home. and you learn. You add that lesson to your inner catalog. Sycamore seeds look like this, avoid them. That lesson learned once and deeply will save you millions over a lifetime. It's the agriculture of error. You till it back into the soil of your experience where it becomes fertilizer for future growth. Now, here's where modern life tricks people. They turn even a clean admission of error into a complicated mess with taxes. They sell the loser for a loss, then immediately buy it back because they miss it, or because they think, well, I like it again at this price, and then they discover the wash sale rule. The IRS describes a wash sale as selling securities at a loss and acquiring the same substantially identical security within 30 days before or after the sale, and in that case, the loss can be disallowed. Schwab explains it in plain English too. Sell at a loss, buy the same or substantially identical within 30 days. You typically cannot claim the loss the way you wanted, at least not right now. So if you're digging up the sycamore, don't quietly replant the same sycamore in disguise. The whole point is to free capital and fix the mistake, not to play a little shell game with yourself. The second reason, when the fundamentals permanently deteriorate, watching the moat fill in. Now, the second reason, this one is subtler. It requires a different kind of vigilance. It's not about you being wrong at the start. You might have been perfectly right. You bought a fantastic business with a wide moat at a fair price for years. It chugs along, compounding beautifully. You're a genius, but the world doesn't stand still. Nothing is permanent, not even the mightiest castle wall. This reason is when the fundamentals of the business itself undergo a permanent, irreversible change for the worse. When the moat, that beautiful defensive barrier, begins to silt up. You see, a wonderful business isn't wonderful because it makes a popular product today. It's wonderful because it has a durable competitive advantage that allows it to earn high returns on capital for decades. That moat can be a brand. Think of that happiness in a bottle, Coca-Cola. It can be a low-cost position, Geico's model. It can be a regulatory license, a network effect, a secret recipe. But moats are not static. They are dynamic. They require maintenance. They face erosion from new rivers of technology, shifts in consumer behavior, changes in the regulatory landscape. Complacent management can neglect the walls. Arrogant management can pretend the moat is an ocean. The signs are rarely a 5-alarm fire. It's not a quarterly loss. That can happen to anyone. No, it's a slow, almost imperceptible decline in the metrics that matter. The return on equity, it doesn't plunge. It just slopes gently year after year. The market share doesn't collapse. It erodes a grain of sand at a time. The pricing power, you notice they can't raise prices like they used to without customers squawking. The brand, it doesn't tarnish overnight, but it loses a bit of its luster with a younger generation. It's a process of gentle decay, and your job as an owner, because you must never forget you are an owner, not a renter of a stock symbol, is to monitor that decay to distinguish between a temporary scratch and a terminal rot. I lived this in a very big way with an entire industry, really, newspapers. For the better part of a century, the newspaper business was a license to print money. It was a textbook perfect local monopoly. Where else would a department store run its weekly sale ad? Where would you find a job, an apartment, a used car, the box scores, the obituaries? The moat wasn't the Pulitzer Prize winning journalism. Let's be honest. The moat was the aggregation of a community's entire commercial and social life onto pages of newsprint delivered to your doorstep every morning. The habit, the necessity, the scarcity of distribution channels. It was a fortress. Then came the internet, a slow trickle at first, a few websites, classifieds moving to something called Craigslist. It seemed manageable, a nuisance. And I include myself firmly in this, we thought the core would hold. People will always want the feel of paper. We said, the ads will migrate, but the subscription will remain. We were like watchmen on the castle walls, seeing a new kind of boat in the distance and saying, well, they can't sail up the moat. Our walls are too high. We were looking backward using last century's map to navigate the new world. The fundamental economics weren't being chipped at, they were being dismantled. The moat wasn't under siege. It was being filled in from the bottom with digital sand. The competitive advantage, that beautiful, wide, deep moat, was becoming a historical artifact before our eyes. Did we sell the day the first newspaper launched a website? Of course not. That's not analysis. That's panic. But there comes a moment, a slow dawning, sobering moment, when the trend line becomes the new reality. When you have to say, the business I bought, the fortress I invested in, it no longer exists in that form. What exists now is a smaller, weaker version in a landscape where the very concept of a fortress is obsolete. Selling then, it's not an admission of a past mistake. It's a recognition of a present and future reality. It's sad in a way. It's letting go of something that was once magnificent. There's a grief to it. You're not just selling assets. You're selling a piece of your own understanding of how the world worked. But sentimentality is a luxury you cannot afford as a steward of capital. Your capital is a precious resource. It is loyal only to growth. It feels no nostalgia. Your duty is to deploy it where the walls are still high, the moat's still deep. If you're stationed in a fortress that's crumbling into the sea, you don't order your troops to stand at attention on the sinking battlements for old time's sake. You evacuate, you redeploy them to a stronghold on solid ground. That's the second reason. It requires clear-eyed, unsentimental realism, the courage to see what is not what you wish were still true. It requires the humility to know that even the mightiest business model is not eternal. You are not selling a failure. You are selling a change, and your job is to adapt to it. Now, one more angle that helps people spot this second reason without getting hypnotized by the stock price. Ask yourself a boring question, the kind that doesn't get clicks. Is the business still aligned with your goal and your risk tolerance? The SEC's investor education materials keep coming back to this idea. Know your goals, understand your comfort zone for risk, and make decisions based on a plan, not on emotion. If your plan was built on steady compounding and a durable moat, and the moat is filling in permanently, it's not stubborn to sell, it's responsible. The third reason, when you find monumentally better opportunity, the art of the upgrade. Now, the third reason, this is the rarest, the one that requires the highest degree of conviction and arithmetic, because this isn't about selling something bad or something broken. This is about selling something good to buy something you believe is truly once-in-a-lifetime extraordinary. Let me be very clear. This is not about tinkering. This is not about swapping one decent idea for another slightly more decent idea because you're bored. That's just activity masquerading as strategy. It's the enemy of compounding. No, this is about a disparity of opportunity so vast, so glaring, that it overwhelms the friction costs of selling, the taxes, the commissions, the mental switching costs. It's when the odds are so heavily stacked in your favor that not making the switch would be irrational. Think of it again as managing that farm. You have 40 acres of prime Iowa cornland. It's been in your family for years. The soil is good. The yield is reliable. It pays the mortgage and puts food on the table. Every inch of it, it's a good farm. Then your neighbor who's inherited a fortune and wants to move to Palm Beach tomorrow offers you his adjoining 80 acres. But here's the thing. His land isn't just good, it's magical. It's the kind of land agricultural legends are made of. Deep, black, loamy soil that goes down 6 feet, a natural, never-failing artesian spring right in the middle of it, a perfect southern exposure. You could grow truffles, vineyards, the most exquisite specialty crops imaginable, and he's in such a hurry, he's pricing it like it's scrubland full of rocks. You know, you don't have the cash. The bank will only lend you so much. So you face a choice. You could just admire it and sigh, or you could sell your 40 acres of very good corn land, use that capital plus a sensible amount of debt to buy this extraordinary 80 acres. It's a trade. You are giving up something, you know, something that works, something that has been faithful for a leap of faith into something that has the potential to be generational. The psychological barriers are immense. Inertia is a powerful force. The known is comfortable. The good is the enemy of the great. Why rock the boat? My corn land is fine. You'll be plagued by doubt. What if I'm wrong about the new soil? What if the spring dries up? What if there's a blight? At least my old land was predictable. You'll be accused of greed, of overreaching. In investing, this scenario plays out most vividly during periods of extreme market panic, the kind that comes along a few times in a lifetime, when wonderful, iconic businesses are priced as if they are going out of business tomorrow. When the fear is so palpable you can taste it, and people are selling family jewels for the price of costume jewelry. That's when you look at your portfolio of well-chosen, fairly valued, perfectly good companies, and you look at these screaming bargains on the other side of the fence, and you realize your capital's not optimally deployed. To buy the extraordinary opportunity, you need ammunition. And sometimes the only source of that ammunition is to sell the good. But, and I cannot stress this enough, the bar for extraordinary must be impossibly high. The margin of safety on the new investment must be enormous. You are not just betting on the new business. You are betting against the market's extreme pessimism, and you are overruling your own past successful judgment. This is not a decision based on a hot tip or a chart pattern. This is a decision born from deep fundamental analysis that screams, this is 50 cents for a dollar that will soon be $2, while my current holding is $1 for a dollar that will become $1.30. The math has to be compelling. It's the art of the upgrade. And like any great art, it requires not just technique, but exquisite judgment and a strong stomach. It should leave you feeling a little uneasy, not excited. If you're giddy, you're probably just speculating. If you find yourself doing this more than once every 5 or 10 years, you're probably fooling yourself. You're not finding once-in-a-decade opportunities. You're just a trader in long-term clothing. And we are not traders. We are builders of permanent or near-permanent holdings. Now, I want to add one more truth that people underestimate, and it sits right next to this third reason. Selling is not just about what you buy next. It's about whether you can actually stay invested long enough for the upgrade to work. A lot of people manage to sell the good, and then they freeze. They sit in cash, waiting for the perfect moment. And the market does what it loves to do. It moves without asking permission. Vanguard has shown how missing just a handful of the best days can meaningfully reduce long-term returns, because the best days often cluster around the worst days during recoveries when fear is still loud. So the art of the upgrade is not only buying something better, it's having the temperament to hold it through discomfort. Otherwise, the upgrade is just a story you tell yourself while compounding happens for someone else. The symphony of know what selling is not. Now, I've given you the 3 melodies, the 3 reasons that might justify a sale. But to understand the music, you must also appreciate the silence, the rest between the notes. In many ways, knowing when not to sell is the entire symphony, because the world will bombard you with reasons, false, seductive, emotionally compelling reasons to interrupt your compounding. You must build a fortress of no against them. It is not a reason to sell because the price has gone down. This is perhaps the most common and most destructive error. Mr. Market offers you a lower price for your business and you treat it as bad news. It's insanity. If you thoroughly analyzed and happily bought a business at 100 per share, you should be thrilled to buy more at 80, assuming the business's fundamentals are unchanged. A lower price is a gift. It increases your future rate of return. Selling because the price fell is letting a temporary voting machine dictate your actions when you should be focused on the long-term weighing machine of business value. It's allowing fear to overrule arithmetic. Never sell into a panic, especially your own. It is not a reason to sell because the price has gone up a lot. Time to take profits, that's the cry. But profits for what? To do what with? If you own a piece of a fantastic business that is becoming more valuable, why would you want to stop owning it? Because it's up. You don't sell your farm because someone offers you a great price this year if you know the land will grow even more valuable crops next year and the year after for decades to come. It is not a reason to sell because of macroeconomic predictions, recession, inflation, interest rates, elections, wars. The experts are paid to have opinions and the media is paid to amplify the loudest ones. The noise is constant. And a modern version of that noise is the social media stampede, the hot stock of the week, the idea that if you don't act right now, you'll be left behind. The SEC has warned investors about the significant risks of short-term trading based on social media hype, especially in volatile markets. That's not just a finger wag. It's a reminder that the human brain is not wired for calm decision-making when a crowd is screaming. It is not a reason to sell because of a target price. Some model spits out a number, 150. The stock hits 151. Alarms go off, sell, we've arrived. But the business doesn't know it hit your target. It keeps growing, earning, compounding. Your target price was a snapshot of value at a moment in time based on assumptions. The business is a living, moving picture. If it's still compounding beautifully, why would your rational action be to abandon it? The target price is a servant of your analysis, not a master of your actions. And it is not a reason to sell because you're bored or itchy or because you feel you should be doing something. This is a profound human weakness, the desire for action, the need to feel in control. The market with its constant flickering numbers is the world's most enticing video game. It whispers, make a move, place a bet, show how smart you are. You must resist this whisper. Investing is not a game. It is the deliberate, patient allocation of capital to productive assets. The less you do very often, the better your results. The best investors I know are not addicted to action. They are addicted to understanding. Now, there is one kind of selling that people confuse with boredom selling, and it's worth naming because it's actually rational when done properly. It's rebalancing. Rebalancing is the practice of bringing your portfolio back to your target mix, because when one asset class runs up, your risk level can quietly drift higher than you intended. Fidelity describes rebalancing as adjusting your investments back toward your target allocation to manage risk, maintain diversification, and keep the portfolio aligned with your goals. That can require selling some of what went up. Not because it went up, but because the position got so large that it now behaves like a risk you never agreed to take. That's not fleeing. That's steering. And when you do sell, you don't pretend taxes are imaginary. Holding period matters. Sometimes the difference between long-term and short-term tax treatment is large enough that it changes your math. You don't have to obsess over it, just respect it. The reason I say that is simple. Compounding is after tax. You keep what you keep. That's the game. The IRS basics on capital gains and losses and how losses can be used and carried forward are not trivia. They are part of your return. All of this talk of selling circles back to how you begin, the mindset you adopt, the moment you hit the buy button. When I buy a stock, I don't imagine a line on a chart. I hope this goes up 20%. I try to imagine a desk in an office, a product team, a set of customers, supply chain, a culture. I imagine walking in and saying, I am now your partner. I own a piece of this enterprise. Show me around. My default holding period, forever. Forever is not a literal prison sentence. The 3 reasons provide the keys to the cell, but forever is the default setting. It's the assumption, it's the lens through which you view every subsequent piece of news, every earnings report, every price fluctuation. It moves you from what will the stock do to what will the business be, from what did the chart do today to what does this company earn on capital over a decade, from can I time this to can I understand this. And when you think like a permanent owner, selling becomes a momentous event. It is not done lightly. It is not done in response to noise. It is a surgical procedure performed only when the diagnosis is clear and the alternative is compelling. It is calm. It is rational. It is, above all, rare. Well, we've traveled a good distance, you and I, from the humility of admitting a mistake to the clear-eyed recognition of decay to the high-wire act of trading the good for the great. It's a simple framework, almost deceptively so, but the framework is not the hard part. The arithmetic is not the hard part. The hard part is the temperament. To sit while the crowd stampedes, to act when you must, to confess error, to perceive slow decline, to make the rare upgrade without turning your portfolio into a slot machine. So my final thought for you is this. The next time that urge rises, the itch in your finger to hit the sell button, stop. Get up from the screen, take a long walk, read why you bought it in the first place, and then ask yourself one question that cuts through almost everything. Am I selling for one of my 3 reasons? A reason of business, of value, of rational opportunity? Or am I selling for one of the market's million noisy, seductive, short-sighted reasons? If it's your reason, proceed with calm deliberation. If it's the market's reason, sit back down, take a deep breath, and go back to reading. Let the world rush by. Your job is not to rush. Your job is to own, to understand, to wait. The power is in the pause. The wealth is in the waiting. If you want more frameworks like this, hit like, subscribe, and share this with someone who's been staring at their portfolio like it's a scoreboard. And drop a comment telling me which of the 3 reasons you struggle with most: admitting a mistake, recognizing a moat is fading, or making the rare upgrade.